Welcome to Money and Markets Series 5, Lesson 8. Everything we have covered so far trades on exchanges. Public stocks, bonds, futures, ETFs, currencies. Markets where prices are visible and transactions are near instant. This lesson enters a world without public prices. Private markets, venture capital, private equity, and the mechanics of investing in companies that do not trade on any exchange. The rules are different here. Liquidity does not exist in the same way. Valuation is a negotiation, and the payoff structure, when it works, can be extraordinary. In 2004, a Harvard dropout named Mark Zuckerberg was building a social network in his dorm room. A venture capitalist named Peter Thiel wrote him a check for $500,000. In exchange, Thiel received about 10% of the company. Facebook went public in 2012. That $500,000 investment became worth roughly $1 billion. That is a 2,000 times return. Peter Thiel did not find this opportunity on the New York Stock Exchange. He found it in the private market, where companies raise money before they are public, where there are no daily price quotes, and where investments are locked up for years. Both the rewards and the risks are larger than almost anything in public markets. This lesson is about that world. When most people think about investing, they think about public markets. Stocks listed on exchanges. Prices updated every second. Private markets are everything else. A startup raising its first $1 million from angel investors. A mid-sized company selling shares to a private equity firm. Infrastructure assets built with pension fund capital. The defining feature is illiquidity. There is no exchange where you can sell tomorrow at a publicly known price. Your capital is committed for years. Private markets are large. Global private equity assets exceed $10 trillion. Private credit, venture capital, and infrastructure add trillions more. Most ordinary investors do not directly access these markets. But pension funds, university endowments, and sovereign wealth funds allocate heavily to them because the potential returns justify the wait. Venture capital funds companies that are too new and too risky for traditional investors. Before a startup has revenue, users, or a proven business model, banks will not lend and public markets will not accept it. Venture capitalists step in. They invest in exchange for equity, accepting the high probability that many investments will fail completely. The venture model runs on power law returns. Out of 10 investments, 6 or 7 might return nothing. 2 or 3 might return 2 to 5 times. And 1 might return 100 times. That one winner, a company like Google, Amazon, or Airbnb, pays for all the losses and then some. This is why venture capitalists cannot be risk-averse. Caution guarantees mediocre returns. The strategy only works if you are willing to bet on long shots. Private equity firms invest in established companies, not startups. The classic private equity structure is the leveraged buyout or LBO. The PE firm identifies a company it believes is undervalued. It buys the company using a combination of its own equity, typically 20 to 40%, and borrowed money for the rest. The firm then works to improve the company, cutting costs, expanding to new markets, improving management, or acquiring competitors. After 4 to 7 years, it sells through a stock market listing or to another buyer, ideally at a much higher price. The leverage magnifies returns. A company bought at 10 times earnings and sold at 12 times earnings with heavy debt financing might return 3 or 4 times the equity invested. Private equity funds are organized around a simple structure. The general partner, or GP, is the investment firm. It makes all decisions, manages the portfolio, and charges fees. The limited partners, or LPs, are the investors, pension funds, endowments, sovereign wealth funds, wealthy individuals. They provide capital but have no say in day-to-day decisions. The fee structure is typically 2 and 20. 2% of assets under management per year as a management fee. 20% of profits above a hurdle rate, usually 8% per year as carried interest. Carried interest aligns GP incentives with LP outcomes. The GP earns its big payday only if the fund delivers strong returns. If it fails, the GP earns only the management fee. Every private equity investor learns to expect the J-curve. In the early years of a fund, returns look terrible. The fund has invested capital and is paying fees. Some early investments are struggling, but the successful ones have not yet been sold. Unrealized gains do not show up in returns until the company is actually exited. On a performance chart, the curve dips below zero in the first 3 to 5 years. Then, as exits happen, the good investments are sold at strong multiples. The curve reverses and rises sharply. The final curve looks like the letter J. This creates a behavioral trap. Investors who judge a young fund by early returns will always be disappointed. The relevant number is the final multiple when the fund fully winds down, typically 10 to 12 years after launch. Private equity reports performance using 2 different metrics. The first is IRR, the internal rate of return. This is the annualized percentage return on invested capital, accounting for the timing of cash flows. The second is MOIC, the multiple on invested capital. If you invested 100 million and got back 300 million, your MOIC is 3 times. Both matter, but they tell different stories. IRR can be inflated by returning capital early. A fund that invests and returns money quickly can show a very high IRR on modest absolute gains. MOIC shows the actual multiplication of wealth, regardless of timing. A MOIC of 2 times over 5 years implies an IRR of roughly 15%. The same MOIC over 10 years implies only 7% IRR. Same absolute return. Very different time-weighted performance. Why do investors lock up capital for a decade, accepting uncertainty and complexity, when liquid public markets are available? Because illiquidity is compensated. Across decades of data, private equity has outperformed public equity by several percentage points per year on average. This extra return is the illiquidity premium. The market pays you to wait, to accept risk you cannot quickly exit, and to take on complexity that requires skilled managers. Not every private equity fund earns this premium. Returns are highly dispersed. The top quartile of PE funds dramatically outperforms the bottom quartile, far more than in public markets. Choosing the right managers matters enormously, and those managers are often inaccessible to ordinary investors, which is why private markets remain largely the domain of institutions. Private markets cover companies and assets not traded on public exchanges. Venture capital funds the earliest stages, accepting high failure rates in pursuit of exceptional returns from the rare company that succeeds. Private equity acquires established companies using leverage, improves them, and sells for a profit. LPs provide capital. The GP manages it, earning a 2% management fee and 20% of profits above the hurdle. The J-curve describes the pattern. Early paper losses, late realized gains as winners are sold. IRR measures time-weighted returns. MOIC measures absolute return multiples. Both matter. The illiquidity premium compensates patient investors for waiting. But manager selection is critical. PE returns are far more dispersed than public equity. In the next lesson, we examine a framework that has changed how investors and regulators talk about corporate responsibility (ESG).